After thorough investigation on the stock market, our group decided to use Harry Markowitz's Nobel Prize-winning modern portfolio theory to attempt to beat the market. Throughout this presentation, we will do an analysis of market efficiency, the capital asset pricing model, the modern portfolio theory, data used to conduct our research, and our conclusion based on this data. Before we delve into modern portfolio theory, or MPT, we must correctly understand what an efficient market is. By definition, an efficient market is one where all information is readily available to investors, and prices correspond with this information. Conversely, an inefficient market is one where there is not enough sufficient information for investors to rationally invest. With that being said, some economists follow the efficient market hypothesis, which states that it is impossible to beat the market due to the efficient market's changing prices. According to this hypothesis, the only way to truly obtain a higher return is to purchase riskier investments. The topic of risk is something that we go deeper into in the following slides. The capital asset pricing model is a great tool for investors to use. By definition, it describes the relationship between systematic risk and expected returns for assets. In this case, we will be talking about stocks as assets. It is used wisely for the pricing of risky securities. The formula is shown and takes the risk-free rate, beta, and expected market return into consideration. Once you find the expected return using this model, you can use a security market line to plot the results for a numerous amount of risks, or betas.
This is just one example of a security market line, but there are many that can be made depending on what stock you're trying to analyze. Beta is on the x-axis and expected returns are on the y-axis. Developed by Harry Markowitz, the modern portfolio theory assembles a portfolio of assets to maximize the expected return for a given level of risk. At Markowitz's research, he focuses on how an optimizing investor would behave. He makes an important point that mean and variance are by no means the most precise and general solution. Markowitz preferred a method that was computationally feasible rather than a method that would give precise results but could not be computed. He tests 3 different utility functions and calculates both annual and monthly returns for different amounts of stocks and mutual funds.
Using Markowitz's method of research, we tested 3 portfolios consisting of only stock, 50% stock and 50% bonds, and 80% stock and 20% bonds. To calculate the rate of returns for Portfolio 1, we took data directly from tsp.gov since it consists of 100% stock. For Portfolios 2 and 3, we used a weighted average formula and inserted respective percentages for the portfolios pulled from tsp.gov. We hypothesized that Portfolio 3 would have the highest return with the lowest risk ratio, and that a diversified portfolio would yield a higher return than an undiversified one. While it may seem that the portfolio with the highest return values is the portfolio that will beat the market, we also must consider the riskiness of the portfolio, given that a high-risk portfolio could potentially negate the benefits that could be reaped from high returns.
After conducting the aforementioned tests, we found that portfolios 1 and 3 had the 2 highest return rates of 0.68% and 0.58% respectively. We also calculated their standard deviations, which are also shown on the presentation. In order to determine if one of the portfolios beat the market by consistently providing higher return rates at a lower risk rate than the other portfolios, we calculated the change in standard deviations between the portfolios and compared them to the change in the average return rates for each portfolio. Our rationalization was that if the increase in risk between each portfolio was greater than the increase in the return rate, then switching to that portfolio would incur more negative repercussions than staying with the original portfolio. We used the new minus old divided by old formula to calculate the change in returns and standard deviations between the portfolios. First, we calculated the difference between Portfolio 1 and Portfolio 3, which had the 2 highest average return rates. By switching from Portfolio 3 to Portfolio 1, there was an increase of 17% in the return rates. However, there was also an increase of 23% in the standard deviations, or risk. Since the increase in risk clearly outweighs the increase in returns, we determined that Portfolio 3 was more likely to beat the market than Portfolio 1. Next, we compared the rates using the same formula for Portfolio 3 and Portfolio 2. We found that from switching from Portfolio 2 to Portfolio 3, there was an increase in returns by 32%, but there was also an increase in standard deviations by 63%. Once again, the risk in switching to Portfolio 3 from Portfolio 2 outweighed the benefits of an increased return rate. Therefore, we concluded that Portfolio 2 out of the 3 was the one with the highest chance to beat the market. The scatter plot also clearly shows how each portfolio's standard deviations are related to their return rates. In conclusion, our hypothesis that Portfolio 3, which was made up of 80% stocks and 20% bonds, would beat the market by having a greater increase in return rates rather than risk rates was proven false in the end. Our results proved that out of the 3 portfolios, Portfolio number 2 had the best return rate to risk ratio. This did, however, prove part of our hypothesis that a portfolio that was more diversified would have a more balanced ratio. Once again, Portfolio 2 was the portfolio made up of 50% stocks and 50% bonds, and also had the lowest interest rate or return rates. Clearly, the risk increased from a diversified portfolio of 50-50 to a 100% stock portfolio and to an 80% stock, 20% bond portfolio outweighs the increase in annual returns that each one would receive. A rational investor understands that there are two components to a good stock portfolio: high returns and low risk. You cannot have one without the other if you wish to beat the stock market.